Hey out there, and welcome to another Kevin Strong show. And in this video, we're going to talk about the historic decline in the housing market. Things are getting really bad. They're probably going to get worse before they get better. We're going to talk about that. We're going to look at a chart that talks about the Fed funds rate and how historically that chart has been going down. And despite many economists and pundits who believe the Fed's only going to cut one or two times in 2025, I respectfully disagree. I'm going to show you that Fed fund chart to support my narrative as to why the Fed's going to capitulate, start to rapidly decline rates in the latter part of 2025. And there's some historical data to back that up. So if you're new to the show, welcome. We're going to start off by looking at this article about the historic decline in the housing market. But before I get to that, here's some interesting information I'd like to share with you guys. Real estate agents are just dropping off like flies. A lot of people are getting out of the real estate business in terms of people who sell real estate agents, that is, and people who do mortgages. Typically, people who do mortgages are 100% commission, just like real estate agents. So if the demand isn't there, it slows down, it dries up, obviously, activity. And a lot of people, like others, are living paycheck to paycheck. So you can only go so long with that before you either have to get out of the business, have ample savings to ride through the bad times, or change professions. So there's some research that I did, and I think they said between like October 2022 and January of 2024, roughly 85,000 real estate agents left the business. 85,000. Now that's a small number, I think, to the 400,000 agents who left during the great financial crisis, which I think we're going to say between 2008, 2012, if I'm not mistaken, about 400,000 agents left. However, some predict, as yours truly does as well, that more agents will leave throughout 2025 and beyond. So the National Association of Realtors, which is the big behemoth that kind of runs the real estate agent business, so to speak, I think as of January of last year, they said that the average salary for a real estate agent was somewhere around $46,000. And if you know what the average going rate is for, a decent job, you can make more money than that. Hence, that's the reason why so many people, I think, have gotten out of the business since the lack of demand isn't there. On the mortgage side, there's been some really big companies that have completely got out of the mortgage industry in 2024. Some of the notable mentions are, I believe, was Country Club Mortgage, Fairway Independent Mortgage Corporation. That was a big one. And the cornerstone one was Rocket Companies. They got out last year. I think New York Community Bank Corp, if I'm not mistaken, got out in 2024. And a couple companies that underwent either a merger or an acquisition in 2024 as it relates to the mortgage business, I think was New American Funding, Proprietary Capital, CMG Financial, and First Federal Bank. So that's just a couple of things to kind of tee this thing up, to kind of let you guys know that the market is contracting. As I said at the beginning of the video, things are going to get worse before they get better. Now jumping into this this article here. This article is basically talking about how we're witnessing the biggest collapse of home buyer demand in U.S. history. I think this is true. Mortgage applications have dropped by 63% since the pandemic, surpassing the declines that we saw during the great financial crisis. Compared to pre-pandemic levels, applications remain down 52%. The reason why I think this is so much more ominous than potentially a great financial crisis is that I think we have more debt, which means there's more weight on the average American shoulders that they just can't shrug off like in 2008. Credit card debt, student loan debt, the guys who've been following me on videos talking about corporate debt, the overall debt in the economy. Things are just, from a debt perspective, so much more exacerbated now than in 2008. And that's why I think this thing could really start to spiral out of control quickly. So a home purchased for $400,000 in 2019 with a 3.5% interest rate was basically $1,800. That same home today, priced at $500,000 at the current mortgage rate, roughly around 7.26. I think this article came out February 6th, so it's relatively new. Would be a $3,400 payment. That's almost double. I'm just saying 1,800, 1,800 is 36. I mean, you're almost talking about a double, an increase of $1,600 that many households cannot afford. Think about that. That's a big, 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 big chunk in terms of increasing your monthly mortgage payment, not to mention the maintenance that's associated with it. Property taxes are always rising. Homeowners insurance is always rising. These are moving things that are not fixed costs, like your principal and interest payment, right? Your taxes and your insurance are constantly going up, not to mention the maintenance and all the other debt that you have. The affordability gap crisis is deepening, with the income required to purchase a medium price home now standing at $115,000. The average far above the median household income of $74,000. Like I've said in my previous video, I think about a week ago, I said, and this is just off the top of my head, you need roughly, the old standard was about 3 to 3.5 times your annual gross income you would be able to afford a house. So if you had $100,000 household income, you should be able to afford a $300,000 to $350,000 home. Well, we know that the average home price in America is well above $350,000, and obviously based on this affordability gap figure right here, the average or medium household income is not keeping up with what's needed to afford the average house, and that hence gives you the affordability gap. And as I've said before, something has to break. Either the income has to come up, which I highly doubt, or those home prices in certain markets are going to have to come down to align themselves with the average medium household income in order for the activity in the housing market to pick back up. Thus, we have a long road ahead. However, with interest rates not declining at the necessary pace and wages growing only modestly, it may take years for income to catch up with current level prices. So I agree with this 100%. So what I want to do at this particular time, ladies and gentlemen, is slide over here and show you this the federal funds effective rate, and have you guys take a look at that. And this is going to be my evidence to support why I believe that the Fed's going to have to capitulate the latter half of this year and cut rates. So as you can see, this chart here is interactive. The gray vertical bars basically indicate a recession. So going back to, let's just say 1960, every time this blue line hits the gray, it comes back down. The gray, obviously, vertical bar once again indicates a recession, and the blue graph or the blue line is the Fed effective rate. It goes down. 1970, it goes down. 1975, it goes down. Goes down big time in 1980. Moving all the way up to the 2000 dot-com bubble, it goes down. In 2008, during the great financial crisis, we hit a major recession. It went down. So one thing I want to bring to your attention, since 1980, right here, and as you can see following my mouse, this thing is cascading down. And it's getting ready to roll over. We're going to go into an official recession in 2025, in my humble opinion. This is not financial advice. And as a result, the Fed's fund rate is going down. They will cut more than 2 times in 2025. Book this video because I won't have to eat crow on this one. I'm very, very positive about the outcome of that. Another reason why I think that is, you look from 1980, think about what I'm about to say now, from 1980 till 2024, think about how much debt the American government has accumulated. And because we have accumulated so much debt, they can't afford these interest rates to stay high. And as you can see this historically, as you go on and on and on and carry more and more debt, the less likely the Fed's effective rate is going to be able to go up, because the system can't handle higher interest rates for a long period of time. Otherwise, the system will break. So once again, from 1980s, you can see here, it goes down, it goes down, it goes down, it goes down, it goes down. This kind of mirrored the same level or leveled off at the same level as the great financial crisis, and then it starts to roll over. This is my evidence and support why I think in 2025, the federal government's going to have to capitulate, lower interest rates. Will they get back down to zero like they were here? Who knows? I think they might come close. They're going to at least the Fed funds effective rate is going to at least get down to, I think, 2% by 2026. That's my expectations. I don't know if it's going to go down to zero, but it's definitely going to have to at least come down to this level because, as I've said earlier, we just have too much debt that we can't carry. So this video is getting a little bit long in the tooth. I'm going to switch over to something that I haven't done in a couple of weeks and give you a little bit of a quick stock analysis as to what I did right and what I have done wrong. So let me go ahead and pull this up here, stop the screen and share. Okay, I took a 55% loss on the S&P oil and gas stock symbol XOP. This was basically a rookie mistake. As you can see here, this thing is clearly going down. I think I jumped in up here thinking that it was going to hit some momentum up because obviously there was a strong demand here as far as the volume for that particular day. But overall, the trend is down. This thing does not move a lot. I took out in options, and anybody who's familiar with options know that you need a lot of volatility to go up. That did not happen. And as a result of that, as you can see here, this thing kind of plateaued and started to move back down. So I just got out and I took a 55% loss. Another stock I'm in right now that I'm down quite a bit, but I'm optimistic it's going to turn around next week is Caterpillar. I have some out of the money calls, I think at 372 that expire February 14th. As you can see right here, my analysis was this was a double bottom and it looks like it's getting ready to move up. The last two trading days, Thursday and Friday of last week, a little bit of volume, even though the market sold off on Friday. So I'm hopeful prior to expiration that this thing gets close to my targeted strike price of 372. The MACD looks like it wants to roll up, and the RSI is moving up in a positive direction. So as you can see here, once again, this is a double bottom, which basically means I don't think it's going to go any lower, and it wants to push up, and it just needs the volume. So that was the rationale. I'm still in that market or still in that stock. And the other one that I'm watching next week is Amazon. Amazon took a big hit, and it looks like there's still downward pressure here. As you can see, this is the MACD is down, the RSI is down, and I don't know if this thing's going to stabilize or not. So that's just something that's on my watch list. Whether or not I'm going to move positively or negatively will depend on how this particular stock settles out by Tuesday of next week. So that's going to do it for the Kevin Strong Show. I hope you've got some really good information about the housing market, my rationale, or the reason why I'm supporting my narrative that I think by the latter half of 2025, the Fed's going to capitulate. They're going to have an emergency meeting. They're going to start to cut rates, and they're going to cut rates aggressively. I am not in the camp that the Federal Reserve is only going to cut rates once or twice in 2025. So if you enjoyed this video, got some value out of it, hit the like button. If you've not subscribed to the channel, please do so at this time. And as always, keep your credit score up and your debt down. This was the Kevin Strong Show, and I'll see you in the next one.